The last episode of the Investor Insight series, number 58, was our interview with Mick Gilligan ahead of the upcoming launch of his new book. And this focused exclusively on London-listed investment trusts. And we stay very firmly on that topic this week as we delve into some of the opportunities currently being presented within this market segment. I produce a fortnightly publication which focuses on the movements and current levels of investment trust discounts and premiums. And part of this report looks at the long-term averages of the various investment trust sectors, which we find a useful gauge of sentiment towards different areas of the market. Two sectors which are notably highlighted here at the current time is the London-listed infrastructure and renewable infrastructure investment company sectors, where the simple average of discounts for the constituents of these sectors currently trading around 20% and 25% respectively, having both, over the last 10 years, averaged around a par rating. It is this feature of the investment trust market and the prevalence of some of the share price discounts we are currently seeing, which was a primary reason why the MIGO Opportunities Trust recently announced a range of changes to their investment approach. And today we speak to the co-managers of that trust, Charlotte Cuthbertson and Tom Treanor, to discuss this further. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co.'s Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co. is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Charlotte Cuthbertson and Tom Treanor, the co-managers of the MIGO Opportunities Trust, ticker MIGO. MIGO recently announced several changes to the investment approach and shareholder terms of the trust, and we go into more detail about the evolution of this strategy in our conversation. These changes follow the investment management responsibilities of MIGO transitioning from Premier Miton to Asset Value Investors, or AVI, in 2023, around which time Charlotte also moved from Premier Miton. She previously assisted on managing the MIGO portfolio. The recently announced changes also saw long-term manager Nick Greenwood step down and Tom Treanor become co-manager. Tom joined AVI in 2011 and was appointed to the board of Asset Value Investors in 2017. He's a portfolio manager and also head of research. Tom has focused on closed-end funds over the last 20 years and has a particular skill set in activist engagement. We interviewed Joe Bauernfeind, Chief Executive Officer and Chief Investment Officer of AVI, back in episode 32 of the series, which was published back in September last year, but is still a highly relevant conversation and lays out the unique approach used by this asset manager. But today, we were delighted to be joined by Charlotte and Tom, specialists in the UK investment trust sector, to discuss the current opportunity and how this large and important segment of the UK market is evolving. Please get in touch if you'd like any further information on any of the topics discussed. Charlotte, Tom, good afternoon. Thank you so much for spending some time for this. How are you both doing?
Hi, Gordon.
Very good, thank you. Thank you for having us.
Thank you.
So guys, we've got this kind of regular first question that we have, that we ask in these, and it tends to get a bit of an insight into you and kind of how you go about your work, really. And so we've been asking people for, one of a range of things, really, whether it's an anecdote from a recent meeting that you've had or trip, or an insight into a project that you're doing at the moment, or even just an article or book that you've read recently that you can share. Anything you can give us?
Yeah, I mean, I think one of the project that's taking up all of our time, or most of our time at the moment, is net asset values in investment trusts. So, we've seen, because there's been so much corporate activity, we've seen lots of trusts either in wind down or selling off assets. And there's a huge divergence between stated net asset value and then potentially what prices we're getting for the actual sales. And particularly pertinent for me as I've just sold a flat and bought a house. And obviously there's a very big difference between what the bank says, a house or a flat is worth and then what you actually eventually sell or buy something for. And I think that's the area that's most pertinent to us, and will be an area that's very pertinent to lots of investors in the trust world, is how are these NAVs calculated? How much of this now is based on transaction data? How much of this NAV is based on, discount rate assumptions, lots of different things. I mean, I appreciate it's not a particularly fun anecdote. It's a bit dry, but as the nature of what we'd be doing at the moment.
Yeah, no, that's all good. Yeah, no, sets the scene well. I'm sure we'll come back perhaps in a later question to talk about some of the kind of illiquid underlying holdings and how you're going about assessing some of those. But perhaps let's kind of set the scene for the discussion. You've obviously made a number of changes to the future investment approach behind the MIGO Trust. Could I just ask you to maybe, just for this audience, just kind of run through and summarize what you have announced there?
Yeah, sure. So I guess it's pretty helpful to think about the changes into two broad buckets. So there's the changes to the investment approach, and then there's the kind of corporate level changes that cover things like fees and so on. But to tackle the investment approach question or bucket, first of all, you can really subdivide that into four broad changes that we're making. First one being having greater conviction in the portfolio. And by that, we mean having fewer holdings with larger weights in each of those holdings. And there's a few reasons behind that, really. One, in that we do a lot of research for each investment we're in. And if the thesis plays off, then we want that to have a sizable impact on the NAV of MIGO. There's absolutely no point doing a lot of work on things, getting the thesis right, and then it's 100-bit position that barely moves the dial at all. And then secondly, and linked, I guess, to my next comment, is that all else equal, the fewer holdings you have, the more of each of those trusts you own, and so the larger your percentage stakes are. And that really ties into our plan to become more activist, have greater engagement with portfolio companies. And that's really building on what Nick and Charlotte have been doing for previous 20 years in the case of Nick, the previous 8, in the case of Charlotte, but really just trying to ramp up intensity of that and become, as I say, much more activist in our discussions, boards, and really try and find ways to unlock value that are trapped by those very wide discounts to NAV. Then thirdly, and I guess twins to that really, it's all very well buying something on a wide discount, but not so great if it stays on a wide discount. So looking really for very clear catalysts that will narrow or completely eliminate that discount. And that can include things like continuation votes, perhaps performance or discount triggered tender offers, for example. It's really looking into things there that are going to move the dial in terms of getting discounts down. Then finally, having less equity exposure in the portfolio, and by association, more exposure to alternative asset vehicles. And the reasons for that are twofold. One, the current opportunity set we're seeing, discounts are much wider in the alternative funds. And then secondly, because it's much harder to analyze a NAV that consists of unlisted private assets, tend to get more inefficiencies in pricing, and your research work can really pay off there in terms of outside returns. And then Scarlett, actually for the corporate side of things.
Sure. So obviously one of the big changes is the team. Nick, after 20 years, has stepped down from the day-to-day running of the trust, and obviously I'll be joined by Tom. And that again plays into that sort of increase in activism engagement. Tom has a long history, as does AVI. It's using anecdotes as an engagement to really unlock value. And then the other things that we've put in, what we've tried to do is really be best in class in terms of governance in the corporate side of MIGO. So what we've done, we put in a capital redemption policy, which is quite unusual, as most trusts are trying to get bigger and bigger and bigger. But we believe that what we're trying to focus on is prioritizing returns over asset gathering. So we believe that 150 million is the right size for MIGO. It enables us to invest all the way across the market cap spectrum. And we think that if the trust got too big, out to curtail our abilities, and we would be able to produce the same return. So we had proportionate capital redemption policy, 150 million. What we've also done is try to align ourselves with shareholders as far as possible. So we've cut the base fee to 0.35%, 35 bips, down from 65, so that's nearly half. But we have introduced a performance fee, which is 50% in excess of SONIA plus 3. So our benchmark is SONIA plus 2, so it's higher than our benchmark. So we don't want to be rewarded for lackluster performance. We want to be rewarded for good performance, and we want to be, as I said, as aligned with shareholders as possible. And so, as a whole, and I'm obviously repeating myself a little bit. What we wanted to do was to try and be the best in class. I mean, for two reasons. First of all, we think that was the right thing to do. But secondly, when you're being engaged with boards, it's really useful to be able to say, look, these are all of the things that we're practicing what we preach. These are all the things that I think are the best things to be doing. And finally, we've kept our realization opportunity that we've had for many years now. So every 3 years, shareholders can tender their entire holding if they so wish, and get their cash back.
Great, thank you for that. Yeah, really useful to run through all of that. I mean, a number of the changes that you're making are likely to focus more solely on the current opportunity that you're seeing in the London listed investment company sector at the moment. And we've talked about this quite a lot on the series already with other trusts, but there's just this prevalence of share price discounts that we're seeing in the sector at the moment. I wouldn't mind you guys kind of talking through and evidencing that opportunity from how you're seeing it. I mean, within your kind of target universe, could you talk us through how big an opportunity you see at the moment?
Tom mentioned that one of the things that we're worth thing for changing at portfolio level is reducing our equity exposure. And if you look at the average discount in equity trust, it's very narrow. If these matches come in, and it's also, as Tom mentioned, they're less difficult to value in comparison to some of these alternative assets. But if you go down to look at something like renewables or private equity, I mean, renewables, the average discounts, over 25%. Private equity, it's over 30%. So we think the opportunity set there is still pretty huge. So that's the areas we've been looking at, and it's the classic thing of, why are these areas under pressure? Well, there were a massive issuance boom when you had low interest rates and everyone was looking for yield. Now you've got gilts yielding 4.5%. Investors have gone back to more traditional sources of income. So you have far more sellers than buyers, and we need the trust sector to get back into an equilibrium. That's what's going to narrow discounts. So we think that there will be more consolidation. There'll be more wind ups. There'll be more trusts selling off assets and using the cash to buy back and get out any new shareholders. And we think that that's a really interesting opportunity set for us to tap into.
Tom, you mentioned in an earlier question about having a more concentrated approach, having greater stakes in your kind of underlying holdings, and clearly a lot of that is to do with engagement, having more influence when you come to engage with companies and boards. But we get a sense that there's a lot of different approaches to activism and engagement. Can you kind of talk us through your own playbook and how you describe your own approach to engagement? How do you go about things?
Absolutely, yeah. So I guess the starting point is you need to have issues to engage on in the first place. So you need to be trying to analyze why discounts are there in the first place, and then try and work with a board to chip away at those reasons. so that the shares no longer trade at a discount. In some cases, that may have to involve corporate activity, perhaps sales of assets, buybacks, or even in some cases, complete sale of the entire portfolio or the company itself. I think the overarching ethos that we try and stick to is that our engagement always starts off in private. We'd much rather it stays private as well. And you can really think of an iceberg, if you like, where the majority of our engagement never sees the light of day at all. And it's only in rare cases where things do spill out in public. And what I say is that I think because we have got a track record and the experience, the know-how, and obviously the willingness to go public, that can often mean that we don't need to go public, that we can get results in private. So what we are trying to do, or rather what we're not trying to do, is activism for the sake of PR. We're doing it exclusively to try and unlock value and try and find ways to generate returns for our own shareholders. And the second point to note is that I think there's quite often a perception that you need a very large percentage stake to effectively get what you want, if you like, with boards of companies. We would say that a lot of our time spent really speaking to other shareholders, trying to build up a consensus across the shareholder base, discuss constructively amongst ourselves what our concerns are, what we think might be done about it, and then taking those to the board. I mean, I've heard so many times on boards over the years, you're the only one saying that. Then you speak to the shareholder base, it becomes very clear very quickly that we're far from the only ones, say whatever it is we're saying. So I think having that shareholder outreach is absolutely key. You can have a 29% stake, as we've seen over the last year or so, and still not manage to get what it is you want. Equally, you can have a 5 to 10% stake in a company, and if there's like-minded shareholders there who share your views, that can be a pathway to success.
Yeah, thanks for that. Could I ask you to maybe, I mean, AVI has obviously got a very successful track record in kind of engagement and activism, and looking for, as you mentioned in an earlier question, looking for catalysts or events that might drive value. Could I ask you to maybe bring up an example of a previous holding that kind of exemplifies that approach of kind of how it's worked?
Sure. Well, I guess to my earlier point, the vast majority of our engagements and activism stay private, but there was one, Hypnosis Songs Fund, that blew up in the fourth quarter of 2023. And that was probably our most public engagement. Just give it as a very high profile company in a glamorous sector, much more so than, say, a wind farm or solar panels, etc. So Hypnosis Songs Fund came to market as a music rights investment company in late 2018. And to put it in context, as Charlotte said earlier on, you had a huge issuance boom really from 2009 onwards, when interest rates went down to zero. People could no longer get what they saw as adequate return from UK gilts. So we saw lots of alternative income vehicles come to market. So that would range from the more conventional credit funds, infrastructure funds, renewables, shipping, etc. And that really culminated in two music rights vehicles coming to market in fairly quick succession after each other. Now, the underlying thesis for Hypnosis Songs Fund, we think, was very, very sound. Streaming had really transformed the economics of the asset class. It meant now that rather than one-off lumpy purchases, you had a subscription service. So earnings from those catalogs were much more predictable and much more visible. The problem with this vehicle really was it grew far too quickly for a manager that wasn't resourced well enough. We had question marks over their general competence and their financial nous when it came to negotiating the acquisition catalogs. And the real killer flaw there was you had a very weak board. And we think they were failing to provide proper oversight of financial controls, of the way the vehicle was being run generally, and the acquisition approach that the manager was taking. The things really came to a head when the company breached banking covenants, suspended its dividend as well. And it's at that point that we stepped up our engagement with the board, with the company, spoke with the rest of the shareholder base as well. And really that culminated in us campaigning publicly for shareholders to vote against the vehicle continuing at a vote in fourth quarter of 2023. The outcome was that they failed that vote. Most of the board stepped down, and we played a key role there in appointing 2 directors to the board who ultimately oversaw a successful sale of the company to Blackstone in the end.
Yeah, thank you for that. Yeah, good example of how this whole process works. Yeah, thank you. Um, I mean, let's go back. We've mentioned already in a few questions about NAVs of illiquid holdings and the challenges that some illiquid underlying portfolios can have. But this is clearly a kind of key target area for the trust now. Are there kind of what you would view as kind of best practice when it comes to governance or capital allocation for these sorts of sectors where determining value or the valuation is more challenging, and there's perhaps less flexibility when it comes to capital allocation?
Yeah, so I mean, maybe taking sort of governance first, and one of the big benefits, or should be a big benefit about the investment trust world, is that you have a board and you have oversight, right? You have people there to be guiding the ship. So what we're always looking for is a board that's knowledgeable, you know, independent, and always looking after shareholders. So, that's who they work for. They don't work for the manager, they work for the shareholders. And so what you're wanting from a board, and especially in these kind of assets, is really robust oversight. And I think Charles' example of Gnosis is really perfect. You want a board very thoughtful about valuation. They are robust with the manager. They're thoughtful about cost. And that's, an incredibly important side, I think, that when you have a portfolio of liquid assets, I think the more information that a board can give on the valuation process is also very important. And I think in terms of capital allocation, I mean, there isn't a one-size-fits-all approach. But I mean, I think what we've seen, and if you look at the maths, using cash from realized assets to reduce gearing and do some buybacks, if the trust is sitting on a very wide discount, does produce, far superior IRRs, and reinvesting that money into new investments. And, there's been people that have sort of said, well, this is very short-termist and we want trusts to be, investing for the future, etc. And I think what you have here is, if you've got a trust on a very wide discount and using cash that's come back into the trust to do a buyback and bring that discount in, gives the trust a chance to fight another day. If you leave a trust languishing on a really, really big discount, you can leave yourself open to, and we saw this a bit with equity trusts, you can leave yourself open to an activist or to just very disgruntled shareholders who can see there's a lot of value trapped and they just want the trust to wind down and to move on. So I think there's always this fear, and we get it a lot from boards, say, well, we don't want to get any smaller, There's this big fear of shrinking. But actually, we think that shrinking, doing things like buybacks, bringing that discount in, gives you the opportunity to fight another day. It's sort of shrinking for survival. But, to come back to my earlier point, there is no one size fits all. It's very dependent on the market in which people are trying to realize assets. We talked about what the net asset value is versus what people are prepared to pay for a portfolio. So there's an awful lot of nuance around capital allocation, and that's where engagement is really important. That's where, talking to your shareholders, understanding the market it is very complex, and that's where I think that MIGO does add value, because that's cool. That's what we're here to do.
Yeah, absolutely agree with all of that. I mean, perhaps as a kind of lead on to that, I mean, clearly the London listed investment trust or investment company sector has, and it kind of is experiencing a few challenges at the moment with kind of supply and demand and some governance issues as well in the mix of that. I've heard you guys talk about kind of how you see the sector perhaps evolving in the future, and you kind of alluded to consolidation a little bit in that question. But I've heard you talk about perhaps seeing this slightly more bifurcated market with the kind of large and liquids constituents, and then perhaps some more specialist strategies. Could I ask you to talk through that kind of thinking with this audience?
Yeah, so as you know, I think as you said, and as we talked about, there is an oversupply in investment trust market. Why we have discounts, wealth managers have moved away from the trust world, and you know, we need to get ourselves back into equilibrium. So corporate activity will continue, and that could be hopefully is quite a profitable exercise. We do think that ultimately, we will end up with a bifurcated market because there will be large listed trusts can still be accessed by the bigger wealth managers. And then if you're doing something different, and especially if there's liquidity issues with your underlying portfolio, whether that's UK microcaps, for example, investment trusts, or some of these alternative assets, there's still a place for these. But you have to be doing something different. You have to be offering something to an investor's portfolio that they can't access in another way. So we think some of these sort of maybe some of these equity trusts, they might struggle going forward unless they're really using the investment trust structure to generate returns and to highlight why people should use a trust rather than something like an equivalent open-ended fund. And we've seen, obviously headlines over the past couple of years about whether the investment trust industry is dead and this is the end. And we don't think that's the case. We think we're going through cleanup phase. We are getting rid of the excesses of a huge issuance boom with the backdrop of a very different market. And so we think that this is all very natural, very normal, is part of the cycle. And there is still a value in the investment trust structure. As I said, it's fantastic to access different asset classes, more liquid investments. And so we think that there will be IPOs. I mean, next year, highly unlikely. But a few years down the line, we do think that people will come back and there will be IPOs in this market.
Yeah, absolutely. Yeah, thank you. Guys, we've got a standard opening question, and we've also got a regular final question for this. I wonder if I could squeeze in another one for you guys. It asks for you to highlight kind of one particular area that you have a kind of high conviction in at the moment. I know we've kind of talked about some of the illiquid areas that you're currently kind of very much focusing on. But I wondered if how would you answer that? Is there one particular area that you have particularly high conviction in at the moment?
Yeah, I mean, I would say to preface this that we have high conviction in many areas of the market, but if I only to pick one, that would probably be the listed private equity space, and in particular, the diversified fund of funds like Harvard West and Pantheon that are traded anywhere between 35 and 40% discounts to NAV and have been trading there for a considerable amount of time. And the basic thesis is that in any sort of normal functioning market, that isn't tenable. That there's absolutely no way these discounts can persist in perpetuity without something happening. And that can really be organic. That can be the boards of these funds understanding that the capital allocation policies today haven't really worked. Or it might be inorganic. And we saw that with Apex Alpha recently, where there's a deal to essentially take that private. Now, I think that a lot of people look at the discounts on the list of PE trusts and assume that they're not real discounts, that it's essentially more about inflated NAVs than it is white discounts to NAV. We would push back strongly on that, and we would say that there's evidence there that for the most part, these NAVs are fair and the discounts are real. Now, if you look at the private secondary market, where private investors, institutions, endowments sell interests in PE funds, the average discount there for a buyout fund in Q2 of this year was around 5 or 6% to NAV. There's a very clear arbitrage available there to the boards of Pantheon Harbourvest. They can sell underlying third-party funds at, say, by the 10% discount to NAV, and use the proceeds to buy back their own stock on a 40% discount to NAV. That's clearly very accretive to their shareholders. But I think all in all, the view there is that we are engaged with the boards of these companies, and we would like to see further advances in capital allocation. Ultimately, either the discounts narrow in, or we think we will see it pick up in corporate activity there.
Yeah, thank you for that. Good to finish on an example of the opportunity here and kind of how you're going about things. Yeah, thank you. Charlotte, Tom, thanks again for your time. Really appreciate it. And good to chat.
Thanks very much.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA. Yeah, thank you for that. Good to finish on an example of the opportunity here and kind of how you're going about things. Yeah, thank you. Charlotte, Tom, thanks again for your time. Really appreciate it and good to chat.